so I'll just give you a nod. So I'll take this opportunity to welcome our in-person audience and our online audience to our planned giving seminar here in Abbotsford. As you can see, there's our agenda. We're going to do a quick welcome, discuss what the financial objectives are, why do you need a will, what should I put in my will, the importance of correct naming in a will, and are there other tax benefits to a charity in my will, and then questions and answers. Today's speakers will be myself, Rob from the Fraser Valley Healthcare Foundation, RBC, RDM Lawyers, and KPMG. Fraser Valley Healthcare Foundation works with your community to support your local hospitals, facilities, and programs run by Fraser Health. With a vision to improve the quality of healthcare for our local communities, we do this by fostering partnerships with individuals and organizations. I have a short video that illustrates how these partnerships benefit our hospitals.
I've been doing nursing for almost 20 years. It takes me a while to kind of have that fear of uncertainty, but pandemic and COVID really did challenge me in that.
Really, it put a lot of strain on our resources, finding capacity in terms of beds, machinery, mechanical ventilators. All those things were stretched to the max.
We went from just looking after 16 to 18 patients in the hospital to having a critical care patients up to 35.
As time went on, we got more and more patients, and it got fuller and fuller, and wondering how, were we going to have enough nurses to take care of these? Were we going to have enough people to manage everything? And were we going to be safe?
That was very much a very loud message that leadership had for us, was make sure that you're taking care of yourself before you treat the patients. And that was a big focus on the donning and the doffing of the equipment, making sure that everybody was looking out for each other.
We've got an incredible foundation here, and our foundation has helped us not only with the monetary gifts that they're often providing to us and supporting us, but they showed up in a very tangible way, that they were on the ground. They were working in our emergency operations center. For them, it really gave them a front row seat to what was going on in the hospital and what were the needs. And then they were able to be there in a very present way to be able to say, how can we help?
We had families in all the time, and so I know a lot of us really struggled when we had to basically close our doors to families.
We were sort of scrambling and mobilizing to find a way that we could still include families in our family-centered practice model. And one of the ideas was virtual rounds or video conferencing. And we didn't have the means to do it, so the foundation provided us with a couple of iPads.
The foundation just supplied iPads so that we could still communicate, and the families could see their loved ones. Meant so much.
We had families from all over the country coming in to our virtual meeting rooms, and it was a really beautiful and meaningful and interesting way of connecting with people.
Immediately when things started to kind of shut down, we reached out to Brendan, our executive director here, and we said, let us know what we can do and how can we help you and how can we support you. We actually ended up doing quite a bit of work. We managed all of the donations from the community into the hospital. And so we had very generous donors who came in and helped fed a lot of the hospital staff while they worked on shift. We also helped coordinate all of the personal protection equipment that the community wanted to donate.
It's just made it so much easier to know that they were there. And if we had any requests, I think they really stepped up and helped us do our job better.
As much as there were hard days, there were dark days in that process. We come out of it with so much resiliency of being able to look back and see how far we've come, see what we learned, see what we had within us, and really understand just what we are capable of.
Our team just rely on each other. We believe in each other. We care for each other. And top that with a community that really supported us throughout. It was overwhelming support that the community have given us.
really hope that we can even take those lessons with us. And that not only as individuals, but as a collective organization, as a hospital, we can really lean into that resilience and embrace it and use it for great things in the future, as well as being ready for the next wave.
Everyone came together as a team. So I feel like, the foundation came together with Abbotsford Regional Hospital, and we worked really well together and supported each other. And, we were able to show that we could help more than what we do already. So we became, even a closer family as we worked together.
COVID being such a scary, scary pandemic world problem, all of these guys, frontline workers, the nurses, they're going in there, right? They're doing everything they can. They're rushing in to help the patients and touching these patients. And to me, that's kind of the major thing is kind of, I'm working with heroes.
Perfect. Our current needs here in Abbotsford, we are assisting with the expansion of the ER to an investment of $1.2 million. At Chilliwack General Hospital, we are helping raise funds for radiographic fluoroscopy. In Mission Memorial Hospital, we are assisting with the laboratory upgrades to an investment of $488,000. And in Hope with Fraser Canyon Hospital, we are raising funds for
white lightning kind of visual changes.
Sorry and then about that.
I just said, this is getting worse. And
Sorry about that. Out in Hope with Fraser Canyon Hospital, we were raising funds for ER stretcher beds and a nasopharyngoscope for an investment of $39,000. That's just a little bit about us. Now I would like to call on RBC Wealth Management.
Good day, everybody. My name is Elijah Matties. I'm with RBC Dominion Securities. I just want to thank the team here at Fraser Valley Healthcare for all they do in fundraising for the hospital. I think too often we don't really understand where the funding comes from and the necessities needed by those helping our community and our family and our friends when they come here. So I'm happy that we could help support them in educating you on some ways to give back to them. A little bit about RBC. I come from a team, Andrew's Consulting Group. There's a team of 7 there. I'm an associate wealth and investment advisor. So basically, I work with clients to try to help them plan for their wealth. Try to plan on ways to manage their affairs, transferring wealth to your heirs. Basically, we work with our clients as a team to help provide holistic experience in managing their wealth. So there's many ways to help the charities that we support that can then help our local and global communities. To encourage charitable giving, the government provides you with a tax credit when you make a donation to a charity. Once you give to them, the receipt's issued, and that credit can be used to offset potentially your payable taxes. This afternoon, I'm going to give you some high-level overview on the types of donations that can be provided to the charities and what can qualify for the donation tax credit. For details on how to best deal with these credits, I'll defer to our speakers today from KPMG. And with regards to how donations can affect your heirs and your estate, we'll hear from RDM next. So to start off, what is a charity? In Canada, the CRA sets out specific criteria that must be followed for an organization or foundation to operate as a registered charity. It's important to remember only registered charities have the ability to issue tax donation receipts that qualify for the donation tax credit. There's a few criteria that the charities are required to meet. The first one is the activities the charity puts on or takes care of are have to be in one of four categories. The first one's relief of poverty, so things like food banks, low-cost housing. The next one would be relief of, advancement of education, so colleges, universities, or research institutes are good examples for that. The advancement of religion, so places of worship, and also, things that support our community, are beneficial to their community, so libraries and organizations like the Fraser Valley Healthcare Foundation. So that's the first one. They have to fall into those categories. The second criteria is they need to meet and maintain a charity status as a legal entity. So to do that, they have to be registered either federally, provincially, or territorially. They can only engage, for number three, they can only engage in allowable activities that the charity must maintain direct and control over. Number four, the charity has to be a public or private foundation. And number five, they must keep proper books and records. That means they have to issue complete and accurate receipts for all donations that they receive, as specified in the income tax regulations. And the sixth one is they have to meet an annual spending requirement, which is known as the disbursement quota. When a charity is taking funds in, they have to spend an amount that's calculated annually and has to be used either for their own activities or gifted to qualified organizations or foundations. If you're ever curious about if a foundation is actually a registered charity, on the Canadian government website, you can actually search for that. You can kind of see an example of that on the screen here. So if you go to Canada, www.canada.com, Canada.ca, you can go to the tax menu, and under that section, there's a charity and giving section where you can look up any of the Canadian charities by name. So what's a gift? The CRA considers a gift to be a voluntary transfer of funds and property where you aren't asking for anything in return. Gifts must be used by the charity to fund their activities, where those activities are kind of impacting anything that I mentioned before, the relief of poverty, advancement of education, advancement of religion, or benefiting the community in some way. There's a number of ways you can give to a charity. You can give them cash. You can also give them things like mutual funds or stock. We can also set up other options like endowment funds and charitable trusts. These can be great options for those wanting to create a bit of a legacy of giving. Some charities even accept personal property such as cars, land, or artwork. A donor has many options when looking at how to give. The best thing to do is if you're ever in question if your gift is something that the charity can use or benefit from, give them a quick call and contact their charity gift planning officer. For example, at the foundation, you can either talk to Robert or Liz Harris. The last option that's a possibility that can actually enhance some of your gifting would be through an insurance product. This would be more of a personalized gift, and a discussion with a licensed insurance agent would need to happen, but it's something that may be of benefit to you. So what's not a gift? There's a few things that aren't eligible to be received as a gift for tax purposes, where no receipt can be issued. A gift of service is one that is often greatly appreciated, but donations such as time or skilled services are not eligible for a tax donation receipt. The same applies when paying a basic fee for admission to an event. For instance, if you're going to give a donation and in return you get maybe use of a property or a dinner or tickets to some sort of sporting event, the donation value may not be fully allowed to be deducted as a tax credit. Donating personal property that can't be assessed in value or has very little value, is another thing that is not deemed as a gift. So unfortunately, donating a an old pair of suits or something to that effect, they're not going to help the foundation out. So there's many ways to actually give to charities, where you can actually get a little bit more power for what you give. Donating investments is one of those ways. And I'm going to touch a little bit on the higher level information for donating personal investments. But when we come down to the nitty gritty of it, I'm going to defer to some of the speakers here today at KPMG. Basically, donations of personal investments held in your account can give you some extra added benefits. The Government of Canada eliminated the taxation of capital gains that are triggered when you donate publicly traded securities to a donation. So what that means is when you actually go to sell the investment, you could trigger capital gains on the sale of what you've earned. So instead of doing that, you can directly donate that share or that bond to the charity, and you wouldn't be taxed on it. So the things that would include would be like company shares or bonds that are listed on a stock exchange, mutual funds, potentially any interest in segregated funds. This also applies to shares that you may have acquired if you have an employee stock option. There are many other advanced methods to donating tax efficiently, but that'll be touched on by our next speakers. This is just an example of what it would look like if you had donated shares directly to a charity instead of selling those shares and donating the cash. For example, if you were donating $50,000 worth of RBC shares that are currently valued at $50 each, but you bought them for $12 each, you can see that there's an advantage here of almost $9,000 for your giving power. So the actual cost of giving it the share is about $26,800 versus the cost of $35,600 if you actually sold the share and paid in cash. There's a lot of ways you can tailor your gifting options for you, and it's important to talk to your professionals to develop that option. It's a lot depends on the age you're in, your expenses, your tax situations, even your family dynamics. They're all important factors to consider. Ultimately, we encourage you to chat with a professional to discuss in more detail and see what options are best suited for you. In your booklet, there's a family inventory checklist. This checklist is something that we give to all of our clients. It's a great place to keep your banking information, your investment information, contacts for the professionals you use, whether it be accountants or lawyers or your financial advisor. It also has some spots in there for insurance information, pension info. It's really just somewhere to jot down notes and simplify all that's important information, all the important information to you. If you can't speak for yourself or if you're incapacitated, it also helps if you pass and your spouse is trying to deal with some of these affairs. So the important thing to remember is gifts to charity are one way. You can't give a gift and then take it back. Before you commit to a large donation, you need to make sure that your own financial needs and obligations are fully met. We always encourage clients to develop a wealth plan, and in that wealth plan, take into account the types of charitable givings that they want to give, be it today or into the future. Another equally important thought is that when you're donating to a charity like the foundation, you're making an investment, and you're making a difference in your community. As with any investment, your number one consideration should be the rewards involved with what you're investing in and not just the possible tax benefits. If the donations, are planned and carried out in an efficient manner, it's possible just to free up a bit more and making that gift, potentially go a little bit further. And that's all I have for you guys today. If there's any questions. All right, thanks for your time.
Thank you. And just a reminder to those that are joining us online, if you have any questions, you can just type them in the chat box and I will get those questions asked for you. At this time, can we have our DM come on up?
Great. Good afternoon. I am Hannah Kewick. I'm from RDM Lawyers. RDM is a full-service firm right in downtown Abbotsford. We're that big brown wedge-shaped building right at Five Corners. Personally, I practice in primarily the corporate commercial areas as well as real estate and estate planning. So I'm here to give you a bit of a crash course on estate planning today. Here we go. Agenda, I'm going to be chatting a bit about planning for incapacity, planning for death, and then charitable giving as well. That's why we are here today. There we go. Is it this? Okay. All right. So in taking a look at your estate planning, two things that you should be thinking about: planning for incapacity and planning for death. So between the two, we have 3 estate planning documents that are at your disposal. On the incapacity side of things, we've got what's called a power of attorney and a representation agreement. And then on the planning for death side, we have primarily your will, and there are some other estate planning techniques and tools that you can utilize outside of your will to kind of bolster your estate plan. All right, so planning for incapacity. The first document that we have is what we call a power of attorney. It is a document for use while you are living. It allows you to appoint somebody that we call the attorney to make decisions on your behalf concerning your legal and financial affairs. Really, you can think of it as somebody dealing with sort of the more administrative side of things. This individual has the ability to step into your shoes and do anything that you can legally do in regards to those matters. 9 times out of 10, a power of attorney is used to deal with a bank or financial institution or real estate. Typically, we draft what's called an enduring power of attorney. That means that it is valid when you sign it and when your attorney signs it, continues through any incapacity on your part, terminates on your death if you have not revoked it earlier. We can have more limited powers of attorney that are for use only when certain events happen or for the granting of specific powers. So let's say you were in the middle of a real estate transaction and you knew that you were going to be going out of town, you could grant a specific power of attorney to an individual, allowing them only to execute those real estate documents, but it wouldn't give them the full breadth of access that a power of attorney typically does. Next up, we have what's called a representation agreement, similar to a power of attorney in that you are once again appointing somebody to deal with matters on your behalf, but instead of dealing with legal and financial matters, a representation agreement deals with personal, medical, and healthcare decisions. So you can kind of think of it as if they've just sort of drawn a line down the center of your life and given an agreement to govern each. And again, this is for use while you are living. This only applies when you are incapacitated. Otherwise, of course, you would be making these decisions on your own. 2 types of representation agreements that can be drafted. One is called a standard agreement, the other is a non-standard agreement. It's a bit of a misnomer because the more widely used is the non-standard agreement. It is a broader agreement. It gives more of a, I guess, umbrella authority to your representative to deal with sort of anything on the personal medical health care side of things. So it does cover end-of-life care decisions, but it covers everything in the interim. So if you are incapacitated, even if it's for a short period of time, and somebody needs to make decisions as far as where you're going to be living, what level of care you need, opting in or out of medication, medical treatment, what kind of social interactions you're going to be having, what sort of diet you are going to be eating, I guess. Those are all covered by the non-standard agreement. The standard agreement, again, we don't use it as frequently. It does cover more basic personal and health care matters, routine finances, so it can allow somebody to pay your bills for you, make some really basic purchases like groceries, those sorts of things. Does not allow an individual to refuse or give consent to those major healthcare decisions. And in the event that you have failed to enact either of these documents, so a failure to plan, and if you become incapacitated, unfortunately, the route that an individual is going to have to go down to allow them to make decisions on your behalf is a little more lengthy, it's a little more complicated. It is called a committeeship, or applying to be a committee, and it is a court process. It is a lengthy process. It is quite costly. You're usually looking at a minimum of about $8,000. You do need to have two doctors give medical opinions that you are no longer capable of managing your affairs. So it's not an ideal situation, right? If something were to happen and somebody is trying to make or take steps on your behalf, you don't want them to have to jump through these hoops. It's pretty easy to get a power of attorney and representation agreement in place to cover those events of incapacity should they arise. And then finally, we have planning for death. So most of you are probably familiar with the general concept of a will. It's a legal document that contains instructions regarding your wishes as to how your property is going to be distributed upon your death. A couple of key elements. Your will appoints an executor. This is the individual that carries out the wishes that you've laid out in your will. So they're the one responsible for ensuring that your estate is properly dealt with. If there are any minor children in your life, whether or not you are their parent or you've been appointed as their legal guardian, your will also allow you to appoint guardians should you pass. Your beneficiaries are, of course, named in your will. These are the individuals that are benefiting from your estate, and your estate can also dictate how and when your property is distributed. So we can have things like discretionary trusts included to protect younger beneficiaries, allowing you to indicate that they don't receive the benefit of the estate until they reach a certain age. So, we frequently do between 21 or 25 and allow the executor to have the discretion to distribute funds before they reach that age, but then you don't have a minor just becoming entitled to a portion outright. Probate is a court process that is not required in every estate, but it is frequently required before an executor has the authority to carry out the wishes that you've laid out in your will. So like I said, it is a court process. It's not a stand up and make submissions sort of ordeal, but it is a submission of documentation. So you are disclosing all of the assets of the deceased, their value, copy of the will. The court essentially takes a look at things and decides whether or not the executor has the authority, if the will is legally valid, and then gives the stamp of approval, which allows the executor to start to make steps to to distribute those assets and carry out the wishes that you have dictated in your estate. So like I said, it's not always required. There are ways that we can kind of get around having to go through the probate process unnecessarily. These include holding assets jointly. So spouses typically will be on title to property as joint tenants, maybe own a bank account as joint account holders, have beneficiaries named on RRSPs, life insurance policies, pension plans, the like. Those will all decrease or potentially eliminate the requirement of having to go through the probate process. As far as making changes to a will, you are welcome to do as many wills in your lifetime as you choose. We try and draft wills broadly enough that you're not making changes frequently, but of course specifically enough that they do accomplish your wishes during your lifetime. As long as you have the capacity, you can make changes at any time. As far as changes after death, what this is really getting at is somebody contesting a will, so somebody not agreeing with what they did or usually didn't receive under a will. The only people that have the right to do this are the spouse of the deceased or the children of the deceased. The court does have a very wide discretion as far as varying a will and doing what we call just and equitable. So there's no requirement that a spouse or that children receive equal benefit under a will, but if that's kind of the default, right? So if that's not the case, there needs to be pretty explicit notation as to why, and the court does understand that, of course. Families are they can be messy, right? There can be different scenarios that arise, and they will take things into account, but it is really important to have things properly documented. All right, if you pass without a will, it is called an intestacy, okay? And there is a sort of a family tree that then dictates who is going to benefit under your estate. So if you have a spouse but no children, everything is going to your spouse. If you have children but no spouse, then it's going equally amongst your children. If there was a child that predeceased you but had children of their own, their share would go to their kids. You have a spouse and children. The spouse gets what they call a preferential share, and that is a first portion of your estate. If the kids are mutual to you and your spouse, then the spouse gets the first $300,000. If not, then the first $150,000, and then things are divided after that. So half to the spouse and half to the children. And it is possible to have two or more spouses under our legislation, under our the act that governs wills and estates. And if that is the case, then typically things are divided between the spouses, but the court is usually involved at that point. So as I mentioned earlier, we do typically try and draft your will broadly enough so that you are not forced to make changes constantly, right? We want this document to cover you through the majority of your life, but there are situations where things do need to be a little more detailed when some complex planning is required. Some of these situations are blended families, right? Second marriages. If there are situations where a beneficiary is incapable or disabled, or maybe you have concerns about them spending the money, maybe there is a substance abuse issue, a lack of an ability to manage the asset. If you have a family business, a family farm, that involves a larger discussion on family succession planning, and that's typically where we have a team that works together. So you have your lawyer, your accountant, your financial planner, and we would get a plan in place. And then, of course, any clients that are higher net worth clients are going to require a little more of a complex plan. All right, and then charitable giving. So as Eli mentioned, and as the KPMG team is going to touch on as well, there are various ways that you can provide for a charity through your estate or during your lifetime. You can name a charity in your will, of course. There's real importance on correctly naming the charity, right? So having the correct legal name, the charity's registration number dictated in your will. We want to ensure, of course, that the intended recipient actually does receive that bequest. You need to be very careful about indicating that the funds are to be used by the charity for a specific purpose. We have situations where by the time that will kicks in, by the time the estate is being dealt with, that charity no longer is operating in that area, perhaps no longer needs the funds for that reason. The charity must survive you, so it must be around at the time of your death or at the time that your estate is being dealt with. We can allow for your executor to choose a similar charity, or we can have a backup charity named, but those are all things that do need to be dictated in your will. And there are, of course, other ways of ensuring that a charity can benefit. These are, such things like naming a charity as a beneficiary on a life insurance policy, potentially the owner of a life insurance policy, beneficiary on a registered investment, and these are going to be touched on a little bit more by KPMG. And depending on the scenario, there may be a more financial or tax efficient way for you to structure things than naming the charity in your will itself. But of course, that's something that your team can help you with. And that is essentially it, unless there are any questions online. Oh, okay. There you go.
Thank you, Hannah. And again, if you're online, you're watching, if you have a question, you can type it into the chat box and we'll get those answered for you. At this time, can I get Logan from KPMG to come on up?
Good afternoon, everyone. My name is Logan Song. I'm here today with Laurel Thornton. We are accountants and tax advisors from KPMG. Today, we have a presentation for you discussing some of the key factors to consider in planning your charitable giving from a tax perspective and leaving a larger legacy. So for today's agenda, we'll first go over some tax mechanics of donation tax credit, common types of assets that can be donated, and what donating securities look like, death and taxes, and finally, testamentary donations. So donation tax credit is a non-refundable tax credit that you can get when you make a donation. In a given year, if you donate $200, up to $200, you can get back about 20% of that donation as your donation tax credit. Anything above that, you can get about 45.8% as your donation tax credit. And if you're fortunate enough to be making over $214,000 to $220,000 a year, your donation tax credit rate jumps up to 49.8 or 53.5%. This is a significant tax advantage. If you can utilize it, you're basically able to get back about half of the donation back as your donation tax credit, which can give you more capital to make further donations or leave a larger legacy for your loved ones. This is a non-refundable tax credit, meaning you can use this credit to reduce your tax payable. So if you have $5 of tax payable, you can use donation tax credit of $5 to reduce that tax payable. But you cannot use this credit to create a refund if you don't have tax payable in a year. But if you have made an installment or you've made a tax installment throughout the year through your paychecks, you may be able to get back some of those prepaid taxes. There is a general 75% net income limit on your donation. So if you have $100 of income in a year and you've made $100 of donation, you can only claim $75 of that as your donation in a year. And if you cannot use all of the donation in a year, you can carry that forward for up to 5 years. So it's important to sort of plan what your income level is going to look like when you're thinking of making donations, and plan that ahead of time so you can use all of your donation efficiently. I think most people know that donation is claimable by either yourself or your spouse. If a donation was made in your children's name or your parents' name, those cannot be claimed by yourself. So you need to make sure, if you want to claim the donation, the receipt is issued on your name. These are some of the common types of assets that can be donated. Cash, obviously pretty straightforward. You can donate your investments. You can donate real property. You can donate some personal property called listed personal property. And you can donate your registered accounts. So these are RSPs, RIFs, so you can donate those. You can also donate your life insurance. So donating securities, Eli touched on this already. So just the key thing to remember is, if your investment has appreciated in value over time, it's better to invest that directly as opposed to selling it and donating the proceed afterwards. Because for publicly traded securities, there's a special tax rule where if there's a capital gain, there's a 0% inclusion rule. So you don't trigger capital gain in those cases, and you can keep all of the donation tax credit. One thing to note is, if you are planning on making these donating securities, make sure you talk to your investment advisor ahead of time so transaction clears in time for you to be able to claim the credit in that year. Just simple example, if you have a portfolio that's worth $10,000 now, you purchased it for $5,000, your marginal tax rate is at 40%. And obviously, because you're donating over $200, let's say your donation tax credit rate is 45.8%. So if you sell the investment and donate afterwards, you only end up with $35.80 of your donation tax credit. Whereas if you donate it directly, you get to keep all $45.80 of your donation tax credit. So you can donate real property, land, and building that you own to your charity for their charitable purposes. You can get a donation receipt for that based on the fair market value of the property at the time of donation. And there will be a deemed disposition of the property when you make a donation at that value. So you'll have to report the capital gain on the disposition if the property has appreciated in value. I mentioned that there's that general 75% limit on the amount of donation that can be claimed in a year. That rule is suspended, and you can claim full donation in that year to fully eliminate the capital gain, if that's the case. In some cases, you can make an election to have the donation occur at cost. So then you would not trigger any capital gain, but the donation receipt and the tax credit amount would be lower as well at the cost amount. Just one little thing to mention is, if you are thinking of donating a property in BC to your charity, charity is exempt from property transfer tax as long as they use the property for charitable purposes. So less to worry about for charity if they're receiving a real property as a donation. So you can donate certain personal property, and these are called listed personal property. These include works of art, jewelry, certain rare collections. And again, the same rule applies when you donate. There's going to be a deemed disposition at fair market value. Just one thing to note is, if you purchased the property, these types of property, within 3 years prior to donating, there is a deemed fair market value rule. So your donation receipt amount is going to be lesser of fair market value and costs. So that's something to watch out for. And this 3-year period extends up to 10 years if if you purchase this property with a specific purpose to have it donated to your charity down the road. And there's this $1,000 floor rule for these types of properties. So if you bought it for $500, you're assumed to have bought it for $1,000 at least. So there's that little bit of bump there. And again, for these properties, the capital gain triggered is not subject to that 75% general limit. So all of the capital gain can be sheltered with the donation tax credit. There are certain properties called certified Canadian cultural property. These are like national treasures that you can, if you donate these types of property to a designated institution like generally museums, you can get the donation tax credit for the donation amount for the full value of the property and not have to worry about triggering capital gain. Death and taxes, two certainties in life, and things can get quite complicated when these two things meet. So when you pass away, you have to file your tax return up to the date of death. Your executor has to file the tax return up to the date of death. And that tax return includes all of the income that you've earned up to the date of death. And there will be a deemed disposition of all the property that you own at the time of your death. So this can get quite complex depending on the types of asset an individual owned on death. So if they own investments in portfolios and real property, there will be a capital gain assuming the properties have appreciated in value over time. And because they all come into your income at once in 1 year, it will hit your marginal tax at the higher marginal tax rate. And not to mention the tax filing itself can get quite complicated because generally these filings are done on December 31st, but if you pass in mid-year or something like that, all the reporting has to be cut, and it may require significant professional help to kind of get that together and get that filed depending on how much assets you owned on death. A similar thing happens to your registered accounts, so your RSPs, RIFs. So all of the full amount of the investment comes into your income at once, so it will hit that high marginal rate of tax again. So for these kind of investments, just need to watch out for benefit of having deductions every year as you contribute during your lifetime versus all of it getting included in your income on death at a higher marginal tax rate. Of course, there is a spousal and common law partner rollover available if you do have a surviving spouse. So these registered accounts can be rolled over on a tax-deferred basis. Depending on the types of assets that you owned on death, an estate tax return may be required. So generally, if you own assets that are not owned through a trust or jointly held, they pass through your will and form a part of your estate. And if these assets have reportable income, reportable transactions, or capital gain, an estate tax return is required. And that can get quite complex as well until the estate eventually distribute all of the assets to the designated beneficiaries. So that can get, the tax filing has to be done. And when someone passes, immediately after their death, an estate is created, and the individual and an estate are considered different tax entities. So you have to file a different tax return. For estates, graduated rate estate is an important concept, also known as GREs. So these are testamentary trusts that arise as a result of someone's death. These are significant because they are subject to a graduated rate of tax, meaning if these GREs make $100 of income, they're subject to a lower tax rate than if they were to make $100,000 of income. This is different than most trusts that are subject to a fixed rate of tax at the highest marginal rate. So depending on the asset and types of income it owns, it can have a significant tax advantage. So in order to be a GRE, an estate has to make a designation in its first tax return, T3 tax return. And the GRE status lasts up to 3 years after someone's death. And after that, it loses that status. GREs have some flexibility in terms of the year end that it can choose. So most trusts have a calendar year end ending on December 31st, but these GREs can have a non-calendar year end as well. So if someone passed away on March 31st, a GRE can have a tax year that starts on April 1st to December 31st, or April 1st to March 31st the next year. So there could be some flexibility there on how to plan these things. Now I'll pass it over to Laurel, who will go over testamentary donations.
Okay, so Logan just went through some really technical tax material. I have the last topic of our presentation this evening, which is making testamentary donations. So testamentary donations in general are those that are made upon your death versus during your lifetime. So as our other presenters have mentioned, there's different ways that this can be done. You can leave certain assets or a specified dollar amount of cash to a charity in your will. You can name a charity as a beneficiary of one of your registered accounts, so your RSPs, your RIFs, or your TFSAs. You can name a charity as a beneficiary of your life insurance policy. And there's other ways that you can use life insurance to make a donation through your will. What's nice to know about making testamentary donations is that there is a lot of flexibility with respect to how that donation can be used by the executor of your estate. If a donation is made within the first 36 months, so that's the graduated rate estate concept that Logan mentioned a few slides ago, or up to 60 months post date of death, so then the last couple of years there, you're going to be in the sort of former graduated rate estate category. Regardless, a donation made in that first 5 years post date of death, the executor has the ability to carry back that donation and have it applied in the deceased's final date of death tax return or in the immediately preceding year. And for those two taxation years, you're not subject to the standard 75% of net income limitation for the amount of the donation that you can actually use. So you can use a donation up to 100% of the net income that is reported in those tax returns. Sorry. Okay, getting ahead of ourselves here. So, of course, the estate can use the donation in the year that it makes the donation. It can carry it back to a year when the estate was a graduated rate estate, or it can carry it forward for up to 5 taxation years. So you can see there is quite a lot of flexibility available when a donation is made through your will. In terms of actually making a donation through your will, as our presenters that came before me have mentioned, you can certainly just give a specified dollar amount to a charity in your will, or you can leave other assets like marketable securities portfolios or real estate, etc. Essentially what happens is when the charity receives that donation after your death, they're going to issue a charitable donation receipt up to the fair market value of that property at the time. There's a cash flow consideration that you need to keep in mind when making donations through your will, which is to the extent that the donation is not made before that date of death tax return needs to be filed, what's going to happen practically is that the estate is going to have to finance whatever tax bill is owing for that date of death tax return. And then once the donation is made, a year or two later, say, the executor is going to have to file an adjustment request for that tax return and have the donation carried back and used in that tax return, and then wait for the refund of the taxes previously paid from the CRA. Now, fortunately, in some circumstances, the CRA does have an administrative position that will allow you to actually claim the donation in that date of death tax return prior to when the donation is actually made, if certain criteria are met. This involves, letters and statements back and forth between the charity and the estate acknowledging the gift and how much the gift is going to be valued at, providing a copy of the will, etc. So in certain circumstances, there is a relieving provision available to help deal with that cash flow mismatch. With respect to donating your registered accounts, as Hannah mentioned, you can simply name the charity as a beneficiary of those accounts. And when you do have a named beneficiary of your registered accounts, that's not something that is going to attract probate fees. So there can be some savings to your estate by actually naming a charity as a beneficiary of your registered accounts. Of course, that there's still going to be an income inclusion on the date of death tax return for the value of those accounts, but the charity will issue you a tax receipt for the value of the account, which will then be available to offset the tax in that date of death tax return. In terms of donating a life insurance policy, this is very similar to donating your registered account in the sense that you simply can name the charity as a beneficiary of your life insurance policy. And again, by naming a beneficiary and not just having the proceeds go to your estate, you can have some probate fee savings there. When you pass away, the charity is going to issue a donation receipt for the value of the life insurance proceeds that it receives, which again then can be used by your executor in either your date of death tax return or perhaps another estate return. Something to keep in mind with naming a beneficiary of either a registered account or your life insurance policy is that, generally speaking, those decisions are revocable. So that means that should your circumstances change in the future, you can change the beneficiary of those accounts or that life insurance policy to another individual or even a different charity, should you choose to make that change prior to your date of death. In terms of other ways that you can use life insurance to make charitable donations, you can, in addition to naming a charity as the beneficiary of your policy, you can also name it as the owner of your policy. And the concept here is you as the individual carry on making your annual policy premium payments. The charity will issue you a donation receipt for the value of those annual payments that you're making, so you can have the benefit of that donation receipt and donation tax credit annually for the rest of your life. And depending on the nature of your insurance policy, there may be an actual accrued fair market value attached to that policy at the time of making the ownership change. Should that exist, the charity will also give you a donation receipt for the value of the insurance policy that you make it an owner of. Now, something to keep in mind is when you're going this route, it's not a revocable change. So it is a permanent decision. You can't undo this. So if you're going to go the route of making a charity the owner of your life insurance policy, that's something that you want to make sure that you've thought about thoroughly and you're comfortable with making that change. So planning really is key. In order to, making charitable donations shouldn't be driven by the tax benefit that you get, but certainly with making large donations, it really is advisable to make sure that you're planning to make them in a way such that you can make the most use out of the charitable donation tax credit that you get along with making the donation. In terms of assessing what type of giving strategy works for you in your circumstances, you need to look at what your current income cash flows are, what your expected cash needs are for the remainder of your life, what other assets you have that you may want to give away. And, you know, to the extent you have a larger amount of annual income and you can make use of a charitable donation tax credit regularly throughout your lifetime, perhaps giving during your lifetime makes most sense. If you have a lower amount of income and you need to retain that cash for your own personal expenses and needs and whatnot, perhaps donating an asset at the time of your death makes the most sense. So once you've sort of stepped back and figured out, you know, what you have, what you want to give away, when you want to give that away, you certainly want to consult with your team of professionals, so your accountant, your lawyer, your financial advisor, to make sure that your strategy can be put into action in the most efficient and effective way possible. That concludes the formal part of our presentation this evening. So if there's any questions, I'm happy to take them. Otherwise, I will pass it back to Rob.
Thank you, Laurel. There's no questions at this time from either audience. Did I go the right way? However, should you, while reviewing this material and have a question at a later date, you can email me, and I will get that question out to our presenters and get you an answer back. Having said that, I'd like to thank those that came out to join us here in person and those that are watching online for joining our presentation. And of course, many thanks to our presenters for taking the time out of their schedules to come and educate.